Welcome.
I'm serious.
You mean mint like that car is mint?
Yeah, like that's
Nice.
mint.
So
He
to catch
actually,
you guys all up who are listening, we were going to bring back a couple things. We were going to bring back Nards. I think we don't use that quite enough. And Bobby claims his brother bought back mint, which I think is cool. Yes.
it is 100% true. He actually said to me, he goes, I'm going to bring back mint 15 years ago. I'm watching a show. I don't know what it was. Might've been How I Met Your Mother or something like 10 years later. And they go, that's mint. I'm like, he did it.
He did it. He's success.
He did it.
By the way, someone's got to do it. Why not give your damn brother credit for it?
I'm giving him credit. That's it.
Right, welcome to Tradier's, the Trader's Edge podcast. I'm Jim Murio, and that's Bob Iacino. Bob, today we're live. I know a lot of you people are going to watch it recorded. Today is Wednesday, I guess the 17th, right? We saw numbers today. We saw numbers today that were relatively almost blockbuster. We have long said that it seemed like quarter four up into the holiday season was a wild party where people were extending. The numbers are supposed to be good. Is the hangover coming?
I believe it is for a number of things. I tweeted out, and I want to say her name and give her credit, but I tweeted it out, a video done by this person, and I can't find the video, but I tweeted it out, YouTube video. Her name is Anna something or other, and she posted stats about consumer credit. And she pointed to housing, which was fine. No problems with mortgage repossession yet. Auto loans, which are getting worse, but not at a critical level. But credit card debt, based on the data she posted in that video, back to almost record highs, and delinquencies, almost record highs again. That's exactly what we were talking about. That's an interesting statistic after the holiday, and something we talked about during the holidays was the buy now, pay later, which was up 75% from the previous year. Now, no interest on that, but the credit card debts are running between like 18 and 21% interest.
That's wild.
So there might be trouble there.
Right. And when I was just today looking at the credit debt of the chart of credit card debt, and it's gone through the roof. Now, the no recession camp will look at that and say, well, that's because, people are spending, there's money in the system, the economy is expanding. Yeah. Then you look at the delinquency chart, and that changes the story completely, in my opinion.
Yeah. I mean, somebody says credit card debt is going up because that means people are spending. I mean, shocking.
Yeah.
What else do you do?
Exactly.
But the thing is, it's like when you look at the breakdown of credit card debt, it's starting to go more toward groceries. And that's something I think we do. Maybe it did all the time, but when you look at the delinquent credit cards, grocery spending rose, meaning they don't have the cash or the debit card availability to spend on groceries.
Okay.
So that's happening. Anyway, today we have a special guest, as almost always, not every single show, but most, David Settle, who is a market technician. He's an active trader, and he's also the co-founder of Market Scholars, and he's a chartered market technician, which is designation for being a technician on charts. And one more thing, you and he, what's the proper way to say that?
I don't know. I'm not an English guy.
Jim and David have something in common that I want to touch on once we bring David in. So let's bring him in. So I want to throw the first question out to both of you because you guys have something in common that Jim doesn't know about. What is the best basketball play when you don't know who your players are? Okay, you're walking in, you got to teach them. The first thing, is it a give and go? Is it a pick and roll? Is it a clear out? Is it a pass and 3-point shot? What is it?
Well, for me, I can take that first. When I was playing, it was a give and go, which to me meant give me the ball and go away. That's what I thought. But from a coach's standpoint, now I have it different. I like a good solid pick and roll. Why do you ask? And David, what about you?
So when I start kids off, when they're first starting off, it's always the give and go. The terminology we use now is pass and cut, right? Pass and cut to the basket, and trying to drill that into kids is cutting to the basket instead of trying to move away from the basket to get the ball. And So yeah, pass and cut would be the very, very first thing that we build off of.
So you, Bobby, you've realized that we are both basketball coaches, correct?
Yes, that's exactly what it is. And actually, David explained that to me. By the way, that was not a humble brag when David told me that. I told him that we're going to be the shitheads in T-shirts, and he could wear whatever he wanted. And he goes, "Well, I'll be in a shirt and tie because I got to coach high school basketball right after the show."
Well, that's fantastic. So, David, my niece, I've coached for 25 years. You and I, we've actually talked about this once before, I believe. But my niece has taken over the head coaching job at the local high school, a huge, huge high school, the head coaching job for the girls. And hopefully none of the other coaches, but her secret plan is to have me on her bench next year, which I think could be an absolute gas. I'd love it. I've coached for so long, but I haven't in the last 2 years, but I miss it. And the guy I used to coach with, because we're very, very competitive, and he'd be like, "It's for the kids, right?" And I was be held out. It's for the kids. It's for my competitive outlet as well.
I got to throw out to you, Jimmy. My niece is a pretty talented basketball player at a high school in your area, a very, very big high school. She's a freshman going on sophomore. So
is her last name the same as yours or no?
No, but it is does end in a vowel.
Tell me what it is, and I'll look for her when we play her.
Yeah,
I go to all my niece's games. My niece is doing such a great job.
Yeah. One of the fun things about it is these small towns, whenever you get together and you get like whole communities in the gym, packed gyms, and there's just nothing more than that. So it's a blast.
I agree completely. We are Palatine and Friend. We have two high schools in the same town. Bobby knows Chicago area well, and the two high schools absolutely hate each other and are friends too. They go to the same restaurants, they play in the same. They're buddies. But the second we get on the court, they were green, we were red. It is an absolute war, and it is hysterical. I love it.
Good times.
Anyway, some of the people I've heard turn into these podcasts to talk about markets and economic events. So maybe we pivot over to there eventually. Where do you live now? You still in Utah?
You're still in Utah. Yep. Still in Utah here. So the market closes early in the afternoon over here.
Good. Do you ski?
Not during basketball season, unfortunately. So we have to wait for basketball season to end.
Dedicated.
Okay. Did you hear what we were talking about prior to the show about the blockbuster numbers today? I'm curious as to where you fall on that.
Yeah, it's interesting to see. There has been. It's interesting to see so many people talk about. The reset. You talked about the recession, and the recession that we're supposed to have has been postponed. I see tweets about that over and over and over again. The recession that all 2023 we're supposed to have this recession. It gets postponed. It's like, well, how often have we ever had a recession? First of all, how often have we ever anticipated a recession and then got it? Like where people say, "Hey, we're going to have a recession. Oh, here it comes. Oh, here it is now, and there it is, and it's nice and projected." And usually the people, when the recession comes, nobody's expecting it. In fact, that's usually when the chatter about soft landing is actually the loudest. Is right before recessions come, and then you look at like yield curve inversions, and you think, how often have we actually had recessions when the yield curve has been inverted, especially as much as it has been inverted, for as long as it has been inverted? So any chatter about like, oh, we've avoided the recession, a soft landing is very premature. And you see, like, again, confirmation of that data that we see today. So this is the kind of like leading data you'll start to see when you see cracks of weakness.
And so the way you described it is that the soft landing talk continues until, right up until the last minute. And we've seen that before. We saw that before the financial crisis too. But it's kind of our jobs to see there's got to be fissures out there somewhere that the shakes and the vibrations will turn into cracks and turn into an earthquake. I thought it would be in commercial real estate. It kind of has, but I don't see any big banks going under because they wrote too many commercial real estate loans. Do you? And then, Bobby, I want to ask you this question too. First, where do you see that the black swan is going to be? And I know you can't see black swan. That's the whole point of it, but it's our job to try. David?
Oh, for me. So yeah, it's to me, it always starts with the consumer, right? That's our economy. Our economy is a consumer. You saw that you talked about that with the credit card delinquencies and again, the cost of borrowing on just about anything and everything is insanely high, relatively speaking, to what we've seen for the past 10, 15 years or so. So in my opinion, once people start to feel the full brunt of the interest payments that they're paying on new mortgages, new cars, credit cards, student loans, again, that they're having to re-pick up. And once we start to see the full impact of that hitting consumers, especially as we're starting to see some of the layoff some small increases in layoffs and quit rate, or significant decreases in quit rates, that's going to be, in my opinion, the crack that really hits hard.
So Bobby, I want to throw it to you for an answer to that, and then you got the next question too. But do you think we need substantial cracks in the labor market for all those things to come to a head?
I do, and it's troubling that we have to. So let me explain why I say it's troubling. I look forward to recessions from an investment standpoint, okay, because you generally get a really good entry on longer term buy and hold positions, in whether you're looking at sector ETFs or whether you're looking at individual stocks or whether you're just looking at the indices, right? And so you get really, really good entries, and you get them at the same time, generally, that the Fed is aggressively lowering rates, meaning that your cash isn't earning much anymore, right? So I look forward to recessions, but the human toll of them are difficult, right? So you sit here as somebody who looks at markets for a living, which all three of us do, and I try to get people to look at it from a perspective of, look, we're here to tell you if we think a recession is going to come or not. You shouldn't care. Like, insulate yourself from economic and market turmoil as best you can. And, again, I'm talking about longer term investing here. You buy when it's bad and you sell when it's good. And I don't think enough people sell when it's good, to be honest. I actually, Jimmy, you don't even know this. Myself and Mike Arnold wrote a book. We finished it during the pandemic, and it was called Rent the Bull Market, Don't Own It. And it's sitting here, like, I can click on the Google sheet at the top here and I can pull the book up, but never did anything with it. Never went anywhere with it. It just sits on my computer. And the whole idea of that was, going forward, as we exist in a fiscal world or a financial world, for lack of a better phrase, where the Fed is going to intervene and politics is going to fight the Fed in either direction, making their intervention even more difficult, right? You have to be more cautious when things are up, not so cautious when things are down, right? Because the Fed's going to jump in theory, at least until proven otherwise, right?
Yeah.
So I think from that perspective, I do think there has to be individual pain in order for the individual investment profit longer term to be more substantial.
I like it. David, thoughts?
Yeah. The Fed's. I mean, that's kind of what all 2023 was about. Like, the Fed's going to step in, and in fact, all the way up to May 10th, if I remember correctly, all the way up to May 10th, there was like an 80+% chance that we would have our second rate cut of the year, of last calendar year, at that December meeting.
Yeah.
And so here I was the whole time talking about, like, look, if the markets want, because that was the bullish narrative, the Fed's going to cut rates and we're going to be fine. And it's like, well, the bullish narrative is actually wrong. Like, if we want to be bullish, which we ended up being, we actually need no rate cuts for 2023. Right. And we need that yield curve to stay inverted as long as possible. An inverted yield curve is not a bad thing for bullish markets. It's when it starts to uninvert that is the bad thing, right? That's usually when the Fed's cutting rates. And so that ended up playing out in 2023. No rate cuts. Those odds went from 80+% to zero. Obviously, we had rate hikes, because after May 10th, we still had the one more rate hike left to go. I think we had two rate hikes actually after May 10th.
Let me jump in real quick, because I was one of those people who thought for the bull scenario to happen, we needed the Fed to come back, because it's only been that way for decades. So convince me that we can still have a bull thesis with the Fed not doing anything. Because my thesis was that cracks would happen, the stock market would drop like a quick 10%, the Fed would be pushed from the sidelines, and after that, the bull starts. What's your bull thesis?
Yeah, I think that, ultimately the long-term bullish cycle, like when we start a new long-term bullish cycle, that's what has to happen. The Fed has to cut rates. We have to get, the borrowing costs down, and people can put money back into the system, right? That's the long-term cycle. I don't think we're at the beginning of an economic cycle. I think we're still at the very, very late stages of an economic cycle, which means the longer we can hold off on the Fed having to intervene, that the more we can maintain, these these long-term 10-year PE ratios, which are currently above 30, like 31, 32 last I saw. Like, those aren't levels where new economic cycles, expansionary cycles start. And that's the narrative I've heard for so much, is like, oh, if the Fed's going to start cutting rates, we're going to start a new expansionary cycle. It's like, not with valuations as high as they are right now. That's the point of, like you were talking about, Bobby, with the recession. Like, you like recessions. The whole point of recessions is to break that stuff up, to break up the fact that we have 7 stocks making up 25-30% of the stock market. We have, these 3 sectors essentially making up 50%. I mean, that the whole point of that consolidation is to break all that up so that we can get good values in other areas of the market. And clearly we haven't had that. And even at the end of 2022, we still hadn't had that yet.
So David, you're a chartered market technician. Jimmy and I have said multiple times on all of our shows that both of us are at minimum 90% technical, right?
Sure.
I would go so far as to say, and that Jimmy and I are, Jimmy, correct me if I'm wrong in lumping you into this, we get a fundamental idea and then we see where the charts tell us it makes sense to emphasize or to place that opinion. It's like I'm at the CME again, to play that bet. Like to place that bet.
Oh, right. Yeah, when we do stuff at the CME, we can't say bet.
We can't say bet. Right? So in order to place that bet on our fundamental opinion, the charts have to A, agree to a certain degree, and B, give us a clue as to where the best place to put that in is. Tell us about like your active trading and your active investing philosophy from that perspective.
From that perspective, like the current trends, the strength of the trends, the momentum right now is in those higher growth areas, those Mag 7 areas, those XLK, technology, consumer discretionary, communication services, that we've consolidated so much top end, like so much weighting of the market into those areas, that if we're not playing those areas when they're rotating in the favor, then we're going to miss out on the active returns, the alpha, so to speak, of your long-term portfolio. And for that matter too, like if you're expecting a recession, I do expect that we'll be in a bear market like within a year or two, like sooner, from a long-term perspective, sooner rather than later. Like that's just generally the type of cycle that when you're at the late end stages of an expansionary cycle, when your valuations are so high, that generally tends to happen. So within a year or two, like especially when that yield curve really starts to uninvert, I think we're going to get there. But even with that, from a long-term perspective, that doesn't mean that, okay, I think we're going to be in a bear market, maybe say starting it by the end of this year, when liquidity starts to dry up, then I want to go ahead and put all my long-term portfolio into like lower beta safety trades now, and then miss out on a year like 2023. Mm-hmm. So I say that, and people think, oh, David's been bearish all 2023. No, hardly at all. I haven't been bearish, because I mean, how often do we actually get bear markets? And for me, I define a bear market as when whatever index, S&P 500, Russell, whatever, break the 200-week moving average. Okay. Right? When you break that long-term moving average and stay there, for an extended period of time, because COVID actually broke it, but then bounce right back up like a week or two later, right back above it. So it wouldn't be a bear market from that perspective, but a good extended run. And how often have we had that? Like literally in the last 50 years, we've had maybe 5, like a literal handful of instances where, so if you're thinking that we're going to be in a bear market and you start to position yourself so safely because of that, like in anticipation of that, those corrections that ultimately do turn into bear markets, more often than not, bounce back up to new highs. Well, more often than not, bounce back, and you'll miss out on all of that. So usually you don't see me start to position myself a little bit more safely until we break that long-term average. Because, for example, the last time we did, and right around May of 2008, from that point that we broke that average, we fell like 40+% in the S&P 500. So it's not like I had to wait too long and I lost too much by the time I waited. No, I mean, by then I saved myself a lot of grief waiting for things to bottom out and to wash out before you start to build back up again.
So when you look at the Magnificent Seven and those things that you mentioned, which I think it's just, and if we wanted to have a whole episode on the fundamental implications of having so much concentration of power and money and wealth in these companies, it bugs the shit out of me, but that's not part of the question. Part of the question is, would you be adding new risks to those spots, if they're, I mean, they're still, you know, the momentum's still there. They're still moving higher. I did when Nancy Pelosi bought NVIDIA 3-4 weeks ago. I jumped on that. It was more for fun than for anything else. You know what I mean? It was just like, just so I could say this and get that smile. But I have NVIDIA now. I don't know what to do with it. What do you do when stocks are up? Those stocks are up so much.
You ride until you see them crack, right? You ride them. You have to. I mean, even if you were to just put, like, say, your whole portfolio in the S&P 500, like SPY, like the average retail investor, I'm just gonna put my money in SPY and forget about it and go on. Well, even if you did that, you're 25% concentrated in those 7 stocks. So you're doing it. Even if you don't think you're doing it, you're doing it. But I certainly wouldn't go like, I wouldn't really pile into that. Like, I wouldn't go above and beyond. But if you start to underexpose yourself to those areas, then you're going to have, in a year where the S&P is up 23%, you're going to be up 10, 12%. And you're going to be wondering, why the heck am I lagging behind? And then you'll have like everybody who did do that from an institutional standpoint starts piling into the Russell 2000 at the end of the year to try to get those things back up to where everything else was already heading. So you kind of saw that. And then you see that in January this year, all those people that were piling into those areas already selling those back out once we get past January 1st.
So David, I want to ask your opinion about inflation, just as a general question.
Sure.
And before I do that, I want to throw up a couple of charts since we have a chartered market technician here with us. And the first one is going to be the freight index. Okay. And this is a global freight index. I believe it's from Statistica, as soon as it pops up on the screen. So here's a global container freight index from January 12th, 2023 through January 2024. And all you have to do is look at the last part of it to see the implications of the costs of shipping given the issues in the Red Sea, right? By the way, after I'm done showing you these 2 charts, you're going to know where I stand before I even ask you the question. So here we have this. I don't subscribe to Statistica, so I don't have a longer batch of data. But because I'm talking about inflation and how inflation, the rate of change of inflation has fallen, although it's still up, right? I wanted to point this out. Then the next chart shows us some of the sort of underlying themes that are hidden below the CPI index, okay, kind of hidden in the data, right? So if you look at this next chart, you'll see that goods, durable goods, month over month is minus 5.9%, showing what Jimmy always talks about, how goods inflation in the supply chain has healed. Then you look at durable goods, 3% annualized is down 5.4%, year over year down 1.2%. But look at services X energy, up 5.2% month over month, 3-month annualized up 5%, and then year over year up 5.3%. So looking back at me again, instead of these stupid charts, if you have,
I'd rather look at the charts than you any day, but go on. Though. Yeah.
Believe me, I have a mirror here, so it doesn't matter if I can't see myself here. I can just look over here. You look at the freight rates, which can you obviously see that we saw it during the spike in inflation, and we see it now, that freight rates can be volatile. Do you fall in the camp of a resurgence of inflation or of continued moderation toward 2%, taking the base effects out?
Yeah. So I am in the camp of more of a continuation. Like, I wouldn't say resurgence back up to like 9%.
Yeah, and that's not what I'm asking either.
Yeah. But maintaining 3+%, if not moving up towards 4%. Remember the CPI year over year generally rises when the Fed starts cutting rates more often than not. So once they start cutting rates, there will be a resurgence of inflation anyways. From that,
you saying that's causal or not necessarily? It's just
they tend to go hand in. I mean, the Fed is stimulating demand. That's what what cutting rates is for. It's to stimulate aggregate demand, and so that will push inflation up. Not to a large degree, but remember, inflation and commodities peaked in the middle of 2008 in the last recession, well before the recession, or well after, the recession started in the earlier part of that year.
So before I go to you, Jimmy, if I could, I'm worried about an amplification of the Red Sea situation. I'm not worried about it as it is now. Simply because you just have the drop off in durable goods that I showed you guys on those charts. Did you just hit yourself with your microphone?
Don't tell anybody. We don't have to call attention
You
to that.
literally looked 100 years old when you did that. Oh my God.
What the hell was that?
Your reading glasses came off. That is unbelievable. Anyway, I'm not worried about.
Oh yeah, the show's live. Shit. Okay, go on.
If the Red Sea situation were not to be amplified any more than it is, I'm not necessarily that worried about it, especially because crude oil is not getting boosted by it. You can see the Houthis are not attacking oil and distillate cargo ships. They're attacking container ships, likely because oil-producing countries are funding them, right, Jimmy? So from a perspective of when you see the freight rates that high, do you worry about it, or like is it something you're watching? How do you look at it, Jimmy?
So I think it's a pretty big deal, but only in the context of contagion, only in the context of progression. I don't know where this is going, and I don't know where if other people just do. So markets tend to adjust to the worst possible scenario, right? I mean, that's what you have to do to protect yourself. That's why I'm kind of surprised that oil hasn't reflected that as much as I thought it would. But how to play it, how to bet on it. Sorry, CME. I am not certain of how to do it yet. The second I think you load up on calls and crude, they solve something there. David, what do you got?
So go back to the inflation question there. So to me, inflation is a monetary issue, right? And obviously there are supply issues, but to the supply side to it. But the money supply just spiked up in 2020, 2021 to really, really strong high levels. And then a lot was made in the past year that the M2 supply year over year went negative for the first time, or went to this lowest negative level year over year ever. And it's like, well, in context, the positive year over year gains were also extremely high. And so when you look at like how much was actually drawn out of the system last calendar year versus how much was put into the system the 2 years prior, it's a drop in the bucket. So there is still an insane amount of money in the system that is not very politically expedient to draw it back out. So it's going to be there. And the question is now whether that money changes hands, right? That's the other component. So you have the supply, but then you have that velocity of money of whether it keeps exchanging hands. So obviously the more the economy is growing, the more people are spending. And you saw with the services, that money is changing hands. And the velocity rocketed up in 2022, just rocketed up higher. And it's still, on a year-over-year basis, is its highest change year-over-year that we've seen. So we've gone from this explosion of supply to an explosion of the velocity of money, which leads to inflation, but we can avoid it if we have one thing. And we had that in the mid-90s when we had the soft landing that we all like to look at and say, hey, we're going to have a soft landing just like we did in 94, 95. Well, we had something there in the mid-90s to the end of the decade.
You're going to say something. Hold it. Let me pause you here because there should be a drum roll, Bobby, because I think he's going to say what I always say. You know what I'm
real
getting
quick,
at?
Jimmy's been talking about the money,
What is it?
money
What is
out
it,
there for a
David?
long time. Go ahead.
We had, well, it might not be what you're thinking of, but we had strong real GDP growth, like year over year, strong real GDP growth. What were you going to say?
I thought when I hearken back to the mid 80s and the 90s, I talk about the deflationary pressures of the internet.
The internet. Yeah.
And I was wondering if you were going to say that AI could possibly start to move into that. So, but sorry about my silliness, but we have, this is a silly show.
For certain. I mean, you saw yield. I mean, yields were moving lower that whole 80s and the 90s, right? And especially in that late 90s. But as yields were dropping, real GDP was like near 5% a year on a year over year basis for multiple years.
So here's my question then to both of you then. We've mentioned two separate things here. We mentioned that risk assets badly want the Fed. They love the Fed. We mentioned that there's so much more money in the system. Aren't those the only real two stories? There's an extra almost $3 trillion above trend that's still sloshing around out there. That's one of the reasons we haven't tanked. You throw in the duration insulation based on the Fed's rate hikes, and everybody had rolled into long-term loans. And you turn into the fact that the Fed has conditioned us that if the shit really hits the fan, they're going to ride in on their white horse and save everyone again. Did we just describe everything in that, Bob or David? Which one? Whoever wants to take it.
Go ahead, David.
Yeah. So yeah, I mean, that's what we're conditioned. That's the recency, right? That's what, in fact, we had a small scale of that in 2019, right? When at the end of 2018, when things were really, really bad. And the last time we had a fourth quarter where we bombed, and the Fed stopped raising rates. They said, hey, that last rate hike, we kind of messed up there. And then they stopped their quantitative tightening. And then by about August of 2019, they started cutting rates. So that was what we were conditioned to do, because since the great financial crisis, the real Fed funds rate has been negative, has generally been negative. And anytime it went the slightest positive, the Fed cut. And we saw that in 2019. But this go around, and they tried to say like, hey, this is going to be different this time, higher for longer. They kept saying higher for longer, higher for longer. The idea is before all the way through the 90s and most of the 80s too, and even into the great financial crisis, the real Fed funds rate, for the most part, was always positive. In fact, not only was it always positive, but it was always about 2% above the CPI rate. For the most part, 2.5% above that. And so now we're right around 2% again. And I think what the Fed is trying to say is like, look, we've had this abnormal policy where we're going to ride in our white horse, and anytime things go bad, we're going to cut rates. We're not going to do that anymore. Otherwise, see, the reason why we could do that in post-financial crisis is because the velocity of money was always negative. All that money that was in the system, it stayed on balance sheets. It stayed at the banks. It didn't get pushed. It wasn't changing hands. So we didn't have an inflation problem, right? Inflation stayed at like 3% at the highest. But there's a big difference this go around because velocity exploded and the inflation rate exploded up to 9%. And now they can't do that. Now they can't say, oh, the real Fed funds rate is positive. Let's cut rates. That's what you hear that's the kind of idea. The Fed's going to come in and cut rates because the real Fed funds rate is positive. And we never have that. Well, we've never had that before because we didn't have the velocity issue. Or we had strong real GDP growth in the late 90s. We don't have either one of those right now. Like velocity is super high. Real GDP is okay, but it's not 5%. So absent, velocity coming down and real GDP exploding, we're going to have a resurgence of inflation. And if the Fed were to start cutting rates again right now, we're going to have the commodities are going to go. Commodities might not be rising right now with all this mess in the Red Sea and the Houthis and all that, but it's also not dropping in either. Like it's holding. Or right there around the crude is holding right around $71. It's basing. And if it breaks that, it will probably be because the economy is just not functioning. I mean, not growing and really weakening. Demand is really softening. So most likely that's not going to happen in the next 6 months or so. So more than likely, it's probably going to hit $90 from 70 more than it will hit $50 from 70, say in the next 6 to 9 months or so.
So a couple of things on this. Number one, Jimmy and some others have me rethinking what I think about crude oil in terms of the inflation relationship, because Jimmy was the first one to say this to me, and then a bunch of others agreed with him. So I'm not quite done researching it, but I can't find a link. They both said that lower crude oil prices actually ends up being inflationary because it is so much gasoline consumption. And when the price at the pump goes down, consumers spend on other things. And I think that's sensible. Mm-hmm. Again, I haven't gotten into the data enough to say that that's my view, but I think it's a sensible view. The second thing I'll say is, as we all have talked about multiple times, David, I've seen you comment on this on X. People are insulated to a very large degree in their mortgages because they all financed and refinanced at very low levels, right? Mm-hmm. Kyla Scanlon, who I like a lot, did a piece today where she talked about the housing crisis that we're in. We're not in a housing crisis. From her perspective, it's because her generation can't buy houses because they're too expensive and rates are too high, right? Mm-hmm, but that's hardly a crisis. Jimmy mentioned a couple of weeks ago on one of our shows that the overuse of that word crisis was driving him crazy. But
sure.
From that perspective, I think one of the things that gives me pause here is, and one of the reasons I believe so much in a resurgence in inflation, not to 9%, right, but maybe above 5, and that would be like the high, all right, is because for the Fed to ride in now, right, they're basically stopping the job losses that could potentially come from corporate balance sheets and other things having to resettle to these higher rates because consumers are insulated. The only place they're not insulated is credit cards. The place where they start selling their homes and suffering is job losses, not higher rates, which it has been in the past multiple times. This is, please, you guys tell me this part's wrong, this part's right, because it's kind of a theory I'm working on. I actually am writing a piece on the last legs of inflation and whether it's going to be easy to get those or hard to get those. I think Yellen and the Fed is waiting out the base effects. I don't think they actually believe that they're going to get inflation down another 2% in real terms, right? They're just waiting out the base effects. And because how do you do that with a 3.8% unemployment? If anybody thinks it's going to 5% in the next 6 months, okay, I mean, I'll say it's not, but maybe it will, right? To the point where the Fed could ride in and rescue what? Jimmy will say a drop in stocks, which he'll be right. But that certainly doesn't help the inflation picture at all. I look at two things that make me pretend I'm smarter than everybody else. One of them I just showed you, right? Freight rates.
Sure.
I bring those up when there's dramatic change and everyone's like, wow, he's so smart. Yeah, I look at freight rates, I look at the Manheim used car index, and then I read comic books. So I'm not that smart. Manheim used car index, which is one of the things that was touted as helping to bring inflation down, was used car prices, right? Was negative last month by 51 basis points. To those of you that don't talk basis points, 0.5%. But the previous drop was 2.3%. And the drop before that was 2.6%. So to the chartist here, trends up, even though numbers are negative, right?
Yeah.
And when you look at the overall used car prices, this I got from Mike Singleton over in Invictus Research, who you should actually meet someday, David.
Bright
He
kid.
pulled up a chart. He's a great guy. He pulled up a chart on one of his Daily Edge videos that he does, where he showed that used car prices are 21% off their post-COVID peak, but 32% above their pre-COVID levels.
Right.
So if you cut rates, what are you doing?
Right.
Jimmy, I mean, I'm sort
Well,
of.
I know what they're doing. They're trying to get Biden elected. Ro Khanna came out and said,
Okay, there you go.
He literally said to Jay Powell, if you don't cut rates, you are going to be the guy responsible for having Donald Trump be president. So think again, this is when people, the Fed's not political. Of course, the Fed's political. I can give you amount of evidence. The fact that he didn't start raising rates until after his final appointment. I'm not saying like sometime after his final appointment, the day after his final appointment, he began raising rates. So I think, yes, I think there is a political element of this in an election year. I think he would also be worried and have egg on his face if inflation got started again. But by the way, both you guys have convinced me of some things. I thought that goods were going to fall off a cliff, and they have.
Yeah.
The services part of it going higher. And David, I want you to comment on this too. The services part of it going higher, to me, is the same or like a close cousin to inflation expectations becoming embedded. Because when those people are coming in and arguing for a higher rate and knowing that people will pay it, that to me means the notion's taken hold. Are inflation expectations and rise in service industry somewhat the same thing, David, in your mind?
Yeah, I mean, think about that used car, what you're talking about there with the used car index. I mean, that and the same thing with actually the CPI and anything that's gone up to a large degree over the last couple of years, money supply that's gone up.
Real quick, David, I'm sorry to interrupt you, but something I forgot to add about that is affected by lowered rates. So the demand for used cars will go up if rates go down. Go ahead. I'm sorry about that.
So that pullback that we've seen, this inflationary pullback that we've seen in 2023 is, again, a drop in the bucket compared to the increase that you saw previously. And so, and like you said, if we talk about with the services too, if we're willing to pay, like, because it's come down in price and now we're willing to pay that higher level, because when it gets to a high level, same thing with gasoline, gets up to $4 or $5 a gallon, and you're like, you know what, maybe we don't need to go on that trip, or we don't need to drive up to, Salt Lake City or whatever. Let's just stay home and do something. You start to think that way. Whereas if it drops back down to $3, you're like, hey, or 350 or whatever. Like, hey, let's go up to Salt Lake for what the heck? Let's just go up there. Gas is cheap, right? But it's still pretty darn high compared. So that's that embedded thing that we're talking about, and that the Fed supposedly is so concerned about. But if you look at historically with inflation rates, when it does spike up to high levels, and it's not just a supply issue, right? I mean, that a lot of people talk about, well, the reason why we got up to 9% is because of supply chain, and that was a big part of it. But there was a lot of money supply pumped. There was a lot of money pumped into the system. Fiscal stimulus was one of the highest levels of fiscal stimulus that we've seen since the great financial crisis, right? There's a lot of money, and that money that comes from fiscal went straight into my pockets and went straight to whatever I wanted to spend it on. And that was the point. And that's what created this increase in inflation. But any time that we've ever had any increase of inflation to such a large degree, it's always come back down. It's almost immediate. It never gets up to 9% and stays at 9%. It always comes back down. So this idea that, hey, the Fed's raising rates, they did their job. They won. The mission accomplished because they brought the inflation rate down. It always comes back down. There has never been a time where it hasn't come back down from a high level.
Because high prices are a cure for high prices, is what you're saying, right? I mean,
yes,
people change their behavior.
They change because, and so things, and they're raising, things come down. But then they come down to a point where, hey, let's buy. There's people like in my little town here, there's people buying homes at 7% mortgage rates like it's nothing, or 6% mortgage rates. Whereas if I were to tell you, hey, if you were to get 3%, would you hold off? Of course they would, but they don't think it's ever going to get back to 3%, and 6% is good enough. And so they start to stimulate, and they start to buy, and that's happening. And so the key for the Fed isn't to get the CPI down from 9% to 2% or whatever. The key is to keep it down, and that's never happened, right? It's always gone back up to not maybe again to the same level. But for the most part, it kind of has late in the 70s and every other spike we've had, even in the more moderate jumps in inflation in the mid 2000s with the housing bubble and then the commodity bubble in 2008, it still jumped up, came back down, jumped right back up to the same level again. During the rate cut cycle, jumped right back up to the same level. And so it's going to go back up. It always has been. It always has.
Let's pivot for the last couple of minutes we have here. Let's pivot to markets. We've talked about a lot of what I think is really interesting things, particularly about macro policy. I'm a gold bug. I never intended to be a gold bug. It just kind of happened when I saw profligate spending by the government, poor stewardship of our currency. I still am. I think if the Fed comes back in, and I think they're end quantitative tightening first, start to angle towards quantitative easing. Then I think things like gold, silver, and Bitcoin. You mentioned real estate. You mentioned houses in prime areas like in Utah. My house in Colorado has done very well as well. What markets are you looking at specifically to respond well to different things that are happening in 2024?
Well, again, the same drivers. I will ride that train as long as it will take me until it breaks. I will ride what's the relative strength, right? That's a key technical term. You ride the relative strength until it's just not there anymore. And so, but energy, which had a great 2022, and obviously rotated out of favor in 2023, you would expect, and it's really down. Like stocks like I just saw earlier today, ExxonMobil in particular is really on a downward slide right now. It's had such a great 2022. And kind of topped out at 2023 and has been kind of coming back down over the past 6 weeks or so. Like I like the energy sector once this slide is on, bases out, and we rotate back out of those Mag 7 sectors and into some of these other cyclical areas. Staples has been outperforming discretionary at the beginning of this calendar year. That's kind of an indication to me that things are softening. I like staples. There's a lot of really good value. Dividend stocks didn't do so well in the last calendar year. There's a really, really good value in those types of stocks,
particularly if rates come down. Yeah, but just a tiny thing. What's the Can you describe the pattern you would look for to indicate to you that the Magnificent Seven was rolling over?
There's really the ratio charts that you look at is kind of what I look at, and I look at how, like, for example, an XLK versus an SPY ratio chart, which has been, XLK has been above its moving average compared to SPY for quite a while, especially during this last year, right? And it actually didn't have that big of a dip in 2022. Because it was so strong at the 2021. We don't really understand just how parabolic the market had gotten at the end of 2021. Like the CAPE ratio, which again is that 10-year, for those who don't know, it's a 10-year PE ratio. That's cyclically adjusted, inflation adjusted. They got to 38 at the end. Like, it's only been above 40 during the tech bubble, and they got to 38 at the end of 2021.
Remember,
we were pretty parabolic there, and it was mostly that heavy tech and the Mag 7. Then it was FANG stocks that were leading the way higher. And they pulled back, but they didn't pull back to a large degree in 2022, and they resurged again in 2023. I watched to see when XLK breaks, and it's starting to roll over towards its moving average of its ratio chart with SPY. That's the kind of thing I look for, especially because XLK is a very good barometer because of Apple, Microsoft, and NVIDIA now. NVIDIA has like worked its way up in the last couple of years to like top 5 market cap. And those 3 are XLK. And so it's a pretty good barometer. When that starts to underperform the S&P, we've seen with Apple, like Apple's sitting on its 200-day moving average. NVIDIA had a great week last week. From a technical standpoint, for those who are watching, NVIDIA had a great week last week. You could almost argue that it broke out above a resistance level last week. And on a weekly chart where every bar is weekly pattern. What you want to watch for, and what I've told my clients is, when you get like when the stock has been kind of hitting around resistance and sitting there and kind of converging where it's struggling to get through this supply level, and then all of a sudden breaks, and it kind of does it by itself. I mean, NVIDIA kind of broke last week by itself to the upside. Then watch for it to hold it, because if it breaks right back down below that level, that's what's called like a fake out type pattern. And that is actually a pretty darn bearish pattern. You saw that with the Russell 2000 famously at the end of 2021. That fake out breakout that it had pretty much preceded like that whole correction of 2022. So if NVIDIA like fake out, and I actually expect that it will personally. I think it will, they will drop back to where it was prior to that breakout. Then that's the kind of sign to me that, okay, XLK, which that's a big part of, is starting to rotate out of favor. And that's really the only thing. Microsoft is doing okay, but it's not as weak as Apple. It didn't break out like NVIDIA. But that sector to me is a very good barometer as how much longer we can ride this gravy train, right? Because we'll ride it as long as we can. We'll ride that gravy train. That's the point. That's the point. In the tech bubble, you rode that gravy train as long as you could. I remember when JDS Uniphase was going gangbusters, right? And Qualcomm had the $1,000 price.
$1,000, right?
Right. And we're going to hit that. And then it didn't, right? And then it finally broke in March. But that wasn't the peak of the stock market. Like the stock market, the S&P didn't peak until like September of 2000. But it was definitely a break of what was the concentrated area of the market. So when you see something like that start to occur in XLK, which we haven't, not even close, that's when that rotation will really start to kick in gear.
I don't believe you're old enough to remember that.
Yeah, I was going to say the same exact thing. How old are you, David?
I'm 48, almost 49.
All right. So you remember reading about it while it was happening in the Wall Street Journal.
I was in college.
There we go.
I took out student loans to trade the stock market back then. I opened up my Daytech online account and put my student loan money in that I'm hoping that Biden will forgive me on now, so I don't have to pay it back. And
how many shares of Pets.com did you own at the high?
And put it to work in Qualcomm and JDS Uniphase.
How much Red Hat did you have at the time?
Oh yeah, totally.
All right. So my last question for you is the XLF. Okay. I just can't get behind banks. Again, I liked the chart when it broke out above those levels. That sort of flat top that it did around January of 23, I believe it was. That sort of flat top, and it broke out above that. But we've got when did it break out above? It looks like December 11th, week of December 11th, it broke out above. It feels to me like this is now the pullback and retest of those levels. And I can't get behind banks within a year of bank failure, of multiple bank failures. So how do you feel about the sector and the XLF specifically?
Right. And remember, a lot of the funding things that the Fed created are supposed to expire, supposedly, here in March. So a lot of that liquidity is not necessarily going to be there for them. The reverse repo is really draining at a very, very rapid rate. So that's what really, in my opinion, really helped them rebound from those March lows. They didn't rebound, dramatically. They came up and are retesting their highs, but they're still not off. Like XLF, for example, is not at its 2022, early 2022 high. Financials, they tend to outperform at the very late stages of bear markets, beginning stages of these expansionary cycles. And again, I'm of the belief, and I definitely could be wrong, and I could, it wouldn't be the first time, but I'm of the belief that we're at the very end stages of the expansionary cycle that we started back in 2009. We've just been running and doing great. But I think that we are at the end stages of that. And so I wouldn't be in financials, even like you might trade it in the short term. And I think we're kind of overbought in like an intermediate term basis. So I wouldn't necessarily even like trend trade it right now over the next so many weeks or so. But from a long-term investment, if I were to overweight into that area, I would hold off on doing that until we've had more of until the Fed brings rates down, right? And then that yield curve jumps up to 200, 250, 300 basis points. Then financials look very attractive at that point.
That could assuage some of the bank failure fears that I have, I guess. I mean, probably won't because I don't like the Fed, but Jimmy?
No, I got nothing more. David, as a favor, you were talking about a chart, the XLK versus the SPY, to look at the moving averages of that. Would you send me that tomorrow? I'd love to see it visually. Sure. Of what you're looking at. If you don't mind, I'd like to tweet it out to a lot of the people who watch this to show kind of, because I think that was a really cool value add. Tell the people where they can find you.
Marketscholars.com. So on X, I'm at David Settle 42. If you know that reference to 42, that's the answer to everything, right? Number 42. So
is that Douglas Adams or is that Jackie Robinson? What are we talking about?
No, that is Douglas Adams. Right? Douglas
Adams. Okay, because wasn't Jackie Robinson was 42 as well, right?
Yes. Yep.
Okay. Well, by the way, I got the two possible references of 42. Well, I'm patting myself on the back right now.
I would have said it's Michael Jordan plus 19. That's all I would have said.
Oh, by the way, speaking of Jackie Robinson, real quick, do you guys know a comedian by the name of Shane Gillis?
Yeah.
He just put out a Netflix
Saw it.
special. Were you laughing your ass off?
First of all, the Italian stuff's hysterical. I was dying.
I was dying.
It was awesome.
Yeah.
It was awesome.
But anyway,
I got a last question for both of you before we let you go. Greatest NBA player all time. I know.
Are you kidding me? It's not even close, David.
Chicago guys? Do I have to say this to the Chicago guys?
We have to say
no, you have to answer what you honestly think, so we could tell you you're wrong.
Okay. Michael Jordan wasn't just the best basketball player ever. His level of competitiveness and his level that he demanded that other people play at was not even in the same league as LeBron James. And physically, obviously, you look at LeBron James, he's a physical specimen. I think Michael Jordan, even over the decades of time, could come in with his body and still be the best player in basketball today. David, what do you think?
Today.
Yeah.
Kill it today. Nobody would stop him because they would foul him every time they tried to stop him.
And he was a good free throw shooter, 86%. Yeah.
I told somebody in their 20s that Dennis Rodman could guard LeBron James. They're like, oh, you know what you're talking about. I'm like, not saying he'd leave him at zero. Yeah. I'm just saying he would drive him crazy.
Michael Jordan. About the GOAT debate, the GOAT debate there is, I will say this. How many Hall of Famers do not have an NBA championship because of Michael Jordan?
That's an excellent. Karl Malone, John Stockton, Charles.
Oh my God, I'm putting that in the arsenal.
Yeah, yes.
Reggie Miller, Patrick Ewing,
great players, generational players who could not get over the Jordan Mountain.
Hakeem only has one because Michael retired.
Yeah. Hakeem was, I think, the most underrated player of our lifetime. Hakeem Olajuwon is a terrific player. And what's the guy with the dreads from Toronto and now the Clippers? Kawhi Leonard is one of the most underrated players of a generation, I think, too. He's a bad man. Okay, we could go on with this all day. My wife is waiting for me. We're going to go take the dog for a walk in 20-degree weather. So
enjoy yourself.
Thank you. See you guys. Thank you, David.
Hey, David, thank you.